This is Alan Bush with the Daily Financial Forecast for Thursday, January 7th. In the stock index futures, we are seeing prices sharply lower, especially in the overnight trade. All of this very much linked to news that Chinese equity markets were under severe pressure. In fact, one of their stock markets fell the limit of 7%. All of this seems to be precipitated by the fall in the value of the Chinese yuan. However, with China apparently attempting to export their economic problems elsewhere in the world, that has the influence of causing central banks that are accommodative to become even more accommodative, such as the European Central Bank. Also, central banks that are hawkish, such as the Fed, and to a lesser degree the Bank of England, are likely to become a bit less hawkish. So ultimately that should be supportive to stock index futures. But right now we are caught in the grip of the lower Chinese equity markets that is dominating the headlines. Now moving over to the currencies, the dollar index, which had been higher for several days, is now lower today. This seems to be due to ideas that in light of the Chinese stock market weakness, that it is a reason for the Fed potentially to be a bit less aggressive in raising interest rates. So interest rate differentials, at least today, undermining the dollar index to some degree. Longer term though, we do feel that the dollar is probably going to work higher as the Fed eventually will raise rates again. And we do have the seasonal that persists through March for the dollar index to work higher. So the dollar index, even though a little lower today, I think ultimately will be trading higher over the next couple of months. Seeing the euro currency higher, we did have better economic numbers out of the eurozone. Seeing the pound lower, even though we did have economic numbers better there, with house prices in the UK coming in much better than expected, and the Australian dollar lower after a record Australian trade deficit was reported. Now moving over to the interest rate futures markets, sharp gains yesterday. However, we are very much underperforming the news today with the bonds just a little bit lower. They should have been higher, we would have thought, with a flight to quality bid likely to be the dominant influence in light of the Chinese equity news, and yet the bonds are really underperforming the news. So we still feel that longer term the bond market is headed lower as core inflation rates globally tend to work higher, and the Fed eventually will raise rates, even though right now the probability of a rate increase at the March meeting is down to 52%. Yesterday it was 55%. So any gains in the interest rate markets at the long end, especially the 30-year bonds, should be used as a selling opportunity. So good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.